the first week of the fourth quarter. I'm delighted to be joined by our regular analysts and experts, Mr. Mike Muller, Head of Vitol in Asia, and Mr. Christoph Ruhl, Senior Research Scholar at the Center on Global Energy Policy at Columbia University. Thank you very much, gentlemen, for joining us. As always, on Sundays, we have a little review on the week past in the markets, in the energy markets, and a look at the week ahead with Mike and Christoph. And I would like to start, Mike, with you, if possible, please. We have OPEC meeting tomorrow, obviously for their meeting where we're going to find out if they're going to stick to the current plan of 400K a month or change course. Last week, we saw 3-year highs being hit on oil prices. We blipped $80. What are they going to do tomorrow as a result?
Thanks, Diala. I must confess that many market observers and protagonists have not been watching oil this week. They've been watching other markets like gas, power, and coal. However, yes, indeed, this is a very important time of year for OPEC, and it comes with the backdrop of, let's call it, power crunch concerns in other markets. And the big question is, where are these interconnected and where are they not? So, I mean, clearly OPEC have the challenge ahead of them of managing the periods in the next 3 months or so where inventories may well go to or below, and in all likelihood below, 2019 baseline levels, which I've often referred to as mission accomplished OPEC. And of course, the big question which the world is posing to OPEC is, what is the price range you're happy with? Because the marginal barrel of supply, the spare capacity, is very much in their hands, as spare capacity is basically cancelled out with many countries that are in that OPEC Plus consortium having reached or being very, very close to their total capacity now. And as a consequence, I think a lot of people have started calling on OPEC to maybe consider putting more oil in the market than the 400 a day. Now, I will caution, November has finished trading in Asia, and since most core OPEC oil goes to Asian markets, the Asian market will struggle to absorb oil in November when November cycle is already done. That said, the attention is shifting towards what to do about December. And this tail end of Q4 is typically the period of the year when Asia starts pulling on inventories pretty hard, demand is high, and it becomes increasingly a function of how cold the weather is and such things. But the underlying fact remains, as it has been for months, that demand is causing a disappearance of inventories a lot faster than the 400 a day that OPEC are proposing to put on the market. And it's going to be an awfully delicate, an awfully delicate balance for them to make judgments on whether higher prices are beginning to impact demand, or whether they need to heed the signals coming from substitution, switching into oil fuels out of that power sector I referred to at the beginning.
I mean, OPEC themselves have forecast in their latest report that supply is not going to meet demand over the next few months. You've got America again asking them to please, can you increase production beyond what you're doing at the moment or what you're planning, and you've got outfits like Bank of America saying $100 oil round the corner. What price, Mike, do you think would trigger a definite change in output volumes from OPEC overnight? I mean, what is that magic figure that they're, regardless of where demand may or may not be going, or how secure it is?
I mean, consuming economies, including Washington, have been moaning ever since the price moved into the 70s. But we must remind ourselves we've spent nearly 5 years at an average price of around $110 a barrel not that long ago. And was it detrimental on the economy? Was it hyperinflationary? Clearly, it's not good for demand, and clearly it's not good for many economies, consuming economies, to have that. But one really wonders whether everyone in OPEC is going to go with the flow. A large number of consultants suggesting that a number around 75 is a number that OPEC is happy with. And having made this excursion, I'll call it an excursion so far, up to $80.75, because it only lasted for a few hours on, was it Tuesday morning, and settled here in the very, very high 70s. Yes, we're slightly above that supposed consensus level. But I'm not too sure that OPEC will, it's awfully difficult for me to predict because they take advice from many quarters, but a big fuss was made around a $200 call transaction going on where somebody bought some call options at $200 Brent. I mean, that doesn't mean they're thinking it's going to go to $200. That's a misinterpretation. It just means that the delta of that option might come into the money if prices move substantially higher, and it's a very cheap trade to put on because nobody's going to charge you much for such options. But yes, I can't answer the question where the various forces think it's going to end up. But there were several interviews leading up to this OPEC meeting tomorrow, where some of the senior protagonists, some of the ministers involved, were hinting or giving at least the way I read the stories, that they're comfortable with the momentum of the market, and they don't seem to think there's a big problem with it moving into the 80s. And I mean, last time Washington placed the call to Saudi Arabia and cautioned they'd like to see lower oil prices, I'm not sure OPEC liked what followed. So that's a tricky one. And the other thing, of course, is there is a mindset, I think, that they want to make a fair chunk of money before competition enters the picture in the shape of Iran. Yes, and the Permian.
And we'll get on to Iran, actually. And Christoph, but just to follow on from that, in terms of, you know, OPEC having the option to even increase capacity, does it have the capacity to do so? I mean, obviously Saudi's got some spare, but where is some members obviously don't have that. Do Saudi, the UAE, etc., have the capacity today to turn on more? And also to follow up with you on the question of Iran, that seems to have gone out of the picture. Are we expecting them to come back in the next 6 months?
So there's three things then. So first of all, do they have the capacity? You ask for OPEC, and the answer is yes, if you stick to the core OPEC countries in the GCC. Clearly, the UAE, Saudi Arabia, Kuwait do have capacity left, you know, somewhere in the region of 5 million barrels per day if they were to draw it down to the max, which nobody wants or expects. But then we are dealing here with OPEC Plus, and there's a slightly different picture in that you have also some countries who cannot even perform to current quotas. Nigeria seems to have recovered. Angola is still out, and some of the smaller ones also have problems. Russia, I think, is nearing the maximum output they can produce in the winter, and they have now huge demands from both sides, so to speak, from Europe and from China, especially also on gas production. So they have a lot of catching up to do. But capacity is not the issue here. Second, to pick up where Mike left it, I think the reason that Mike says rightly so he can't predict what this price is, this imaginary price at which OPEC will change tack, is that there is no such price. You know, we have a very clear history of this. OPEC is happy, of course, it's its function in life, to take higher prices, and is willing to change policy, historically has been willing to change policy, always only in the face of severe headwinds. These headwinds could be political, as in pressure from the US and other countries in the past, and that has to be pretty severe to show an effect. They could be economic, as in demand destruction, bad for OPEC itself, or it's showing economic growth, leading to demand destruction later on, also bad for OPEC itself. None of these really severe headlines are in sight yet. And so while I would agree with many analysts who say that 75 is something we can live with, the whole history and just simple logic suggests that they will happily take more money off the table as long as they think it's to be had, and prices would edge up happily around longer. Will that lead to an economic crisis? It's true that we have survived years with $100 oil, but that was driven by very strong underlying economic growth. So here's always a chicken and an egg problem. I suspect that this time prices are more of a problem.
Yeah, and I mean, one headline, saying OPEC acts in the face of headlines, but one headline that's been,
headwinds.
Headwinds. Okay, well, headwinds and headlines.
Only if headwinds are severe.
Well, one headwind that's appearing and is now, nobody's disputing it, is inflation. Okay, that concept of is inflation coming back? Is it temporary? Is it not? I think there's consensus now that we're seeing it. We're seeing it in the Eurozone. We're seeing it, creep up elsewhere. We're obviously seeing price inflation as well, cost push inflation. But that's obviously becoming a concern. Oil is part of that. Oil prices are part of that. Are we in a situation now where oil producers are considering that they are contributing to that worry, or do they still see themselves as separate?
So they probably see themselves as separate with some justification. You have to add the whole energy complex to get some real impact here. Electricity prices have soared, that's a big one, and gas prices underlying that. But I'm sure that if you would be in the boots of OPEC, so to speak, or in the sandals, you would also say this inflation thing has been coming for a long time and was triggered by loose monetary policy, not by us. There's also some subtle difference. Normally, a one-off increase in prices such as energy prices or oil prices is not inflationary. That's just a shift in relative prices. One thing gets more expensive, something else might get cheaper in return. What is inflationary is this creeping up, this constant increase in prices, which we have seen before we reach the 75 level here, and which we may continue to see. and the time lags it takes to feed through the system. So I think that central banks will look at this very carefully, and don't forget, they're in desperate need for someone to blame. Because the reality is this wall of money, which will eventually translate into inflation, has translated into asset price inflation already. That's created by central banks for good or for bad reasons, it's a long argument, but they have been warned. A lot of economists, very supportive of their policies initially, have gone out the last 6 months and said, guys, this is too much now. It's going to create inflation. And so there will be a debate which is also driven by a little bit by a blame game, with OPEC saying, no, it's not us, and the central bank saying, yes, energy prices are to blame, food prices are to blame. And if you calculate them out of the equation, which they do, and then they call it core inflation, the picture looks slightly better. But the fact of the matter is that core inflation is increasing, even without energy prices and food prices. And the root cause of inflation is in monetary policy.
Okay, and I mean, have they left the tapering too late? I mean, now everyone's saying, okay, it's going to happen in November, most likely it's actually going to start. Is that too little, too late in terms of controlling all this other sort of price, I suppose, inflation that we're seeing across commodities, across products?
I have never been, so you're asking the wrong guy, I've never been a great friend of tapering, because to me, this is just central banks buying bonds, in particular commercial bonds. That's just a distortion of the market and a misallocation of capital, despite being inflationary. So they are not too late when the hope was to keep the economy going for a while. But eventually, that's an instrument which has to be taken off the table, and everybody knows it. And then there is this old game of threatening to taper a little bit. I mean, these purchases have to be taken off the table. Then it's the old game of threatening with tapering a little bit, markets showing adverse reaction, the Fed giving in a little bit. And I think this time around, all market participants know that there is no way around taking it off the table except the real economic situation deteriorates, be it by COVID or by an energy crisis or by something like that. But the old chicken and egg problem has already been decided, because I think even ardent Wall Street supporters, they know that this can't go on as it was.
Mike, just to look at Asia, focus on Asia, but obviously China, as usual, making headlines, being a critical, or one of the most critical demand centers. Growth figures there being revised consistently. We have a new average outlook for growth in China that most people seem to agree on. Today, though, it's facing something very immediate, which is it's sort of power crisis, if you like. We just had a headline overnight. China encouraging its coal miners, exceed your quotas as much as possible. Just keep producing. We don't want to have, a worse crisis this winter. So, how serious is the power crisis in China? It's almost self-made, but where do you see that impacting growth in China and demand at the end of the day?
Yes, Diala, there's no straightforward answer, because China's a big country with regional and provincial differences, and it's in several provinces in the very north, which are the ones that tend to take the brunt of cold weather in winter, where some, let's just call them indiscretions, occurred. The twin forces of the clean air policy and the government directives on reducing carbon footprint coming cross purposes with safety-related clampdowns on people that weren't running mines safely. And it really seems to be a little bit about what drives people to fear for their jobs most in what are government organizations. Is it running a safe operation as directed, or is it not having maximum output and supplying the power supply chain? And of course, when the traffic lights went off in one of those northern cities, that was highly embarrassing to the authorities. Mm-hmm. So it's quite understandable that backlash was reassuring, number one, the public that they will have electricity in their homes all winter. And then the directive that you refer to, where indeed, this followed hot on the heels, by the way, by remarkably BBC making this one of their top 5 headlines on Wednesday, I believe. That's, the provincial governor of Jilin province, I think it was, up in the north, calling on the global coal supply chain to help him out with supplies. So yes, it is hardly the best prelude for COP26 on November the 1st that we have the largest coal consuming nation calling to mine the coal harder and to burn it. But then again, I think it's fair to say the same is happening in Europe, because Europe is facing a possible disruption. I mean, I was quite impressed to see in your pre-read you had the little exercise in Nord Rhine-Westphalia in Germany, in the city of Bonn, where there was a great big public awareness campaign. Christoph, I guess there was probably some news on this in your post-election Germany, but it's quite remarkable to see how people are preparing for longer blackouts in Germany, of all places, where you can keep the lights on simply by, well, extending the life of highly unpopular sources of energy that are totally clean, such as nuclear. But back to China, we will get a period of relative quiet over the next week because it's Golden Week in China, the final of the big holiday periods. But I think the scene is set. I mean, you have the prospects of a coolish winter again, causing people to want to stockpile. You're seeing China exporting very little in terms of petroleum products as a result of their quota setting. You're seeing great caution in the business community after various interventionist headlines, Evergrande and the property sector just being the latest of many of those. And then you have the Winter Olympics coming up, which we should not underestimate because Beijing wants to make this a showpiece and doesn't want the skies to be brown. They'd like them to be blue over those, outdoor events. And that's going to result in a big directive, as we saw at the Beijing 2008 Olympics, to close factories wholesale. That in turn is probably going to see a great big surge of industrial activity, productivity beforehand, and then a catch-up exercise afterwards. So there are many, many signals coming out of China, but it is a state economy and the state will ensure there is supply. And I'm afraid in the short term, whilst we talk about clean skies over the Olympics, it's not going to be decarbonization first for the coming months. It's going to be restoring supplies.
And on that point of, what are they going to prioritize? Decarbonization, clean air, or, getting their factories running again? I mean, how much is a lot of factories and industrial production was already dropping in China. How much is the factory slowdown going to kick in more on the supply chain problems that we're seeing globally? We're already having issues, obviously major issues. Do you see China changing its tack on that to sort of ease supply chain issues for the world?
I've long been a bull in these conversations, and then Christoph criticizes me for being too upbeat around China. And I will concede that there is a consensus out there that indeed GDP growth levels in China will be impacted by this general loss in confidence in the investment community, stemming from the issues in the construction sector, which accounts for a large amount of power demand. But we also think that if they need to start chopping discretionary consumption of power, if it comes to that, that will be in heavy industries that are energy intensive, that are of the same sort of category you referred to, Diala, there, which, things like steel mills and smelters, which will then obviously hit GDP and bring us lower economic growth statistics than we had in place and that I was certainly had in my mind a month ago. Yeah.
Christoph, on the supply chain issue, a lot of forecasters are saying now we're not going to see that eased till 2023, the backlog of what we've seen happening the last 12 months. Would you agree with that?
It's going to be, well, no. Supply chain things can be fixed in principle easily once the system sort of rectifies itself. And you have to distinguish different types of construction materials is already easy. Cars is worsening because you have no chips. It's a very isolated, very identifiable stop. Now I have a neighbor here who is in the car industry, in the delivery industry for cars. So they build car seats or something. He's on short labor in the midst of a booming economy where you can't get a plumber. And that's because they can't build cars anymore. They've missed out building 7 million cars globally, I think. And if you want to buy a Mercedes in Germany now, you have to wait 1 year. Well, I told you before, I was in Dubai 2 weeks ago. People complain only about one thing, that you can't get any Maseratis anymore. And that's an isolated example. Energy would be a more bigger issue, but that rectifies itself. But I do want to reiterate something we had discussed previously. I do think something not so nice is brewing in China. And that is because when you look at how they deal with their problems right now, part of this is economic, so they had health and safety issues. So the answer now is, get to work and lower your thermostat and live with lower average temperatures. Part of that is sort of politics of the worst sort, not policy, but politics. There is on October 14 or 16, I think, a UN environmental conference where Xi will speak. So he needs blue skies for that. And as Mike rightly said, for the Olympics. So there is no letting go right now. A few weeks later, no doubt, the skies will be gray again or dark again. And part of that in the international discussion, so in the midst of all of that, they sent a squadron of fighter planes into Taiwan. So it's this continuing centralization in the inside and this continuing sort of throwing around weight to the outside, which is sort of hard to understand in this situation. And then you have the degree of opaqueness so that none of us can know. But all the signals are for the economy being adversely affected and the policy going off in old-fashioned, not very productive tangents. That's very different from Europe, where you also have a bad economic impact, but the policy being sort of wimpish.
Oh, let's talk about Europe a little bit. I just want to go back to sort of gas prices and the winter coming up. I mean, we saw LNG prices again hitting new highs, I believe, last week. How much is the European sort of energy crisis today, the fuel crisis, weighing on the economic recovery outlook for the Eurozone?
Not yet really, because the governments are still stepping in. I mean, they're paying subsidies. And so what is happening here is, on the one hand, sort of the birth pangs of a globalizing market. This is that we are seeing natural gas becoming a globally traded commodity, no longer subject to fixed price contracts, long-term contracts, no longer tied to oil. And so it gets for a whole raft of reasons, which we have no time to discuss, it gets the same characteristics of early oil markets without a cartel in them. It becomes cyclical and very strongly volatile. And the other thing we are seeing is the link to the energy transition. And that I find very, very interesting, because look at some of the key characteristics. One is these very volatile price reactions that comes with liberal markets. We have seen this to the other side. When WTI turned negative, you see what financial investors can do in these markets, and it's necessary on one side as a price signal. It's very disturbing for consumers, especially in Europe, who are used to stable electricity prices, to see this volatility. That will become stronger when the energy succession is underway. Second, we see government reactions, subsidies left, right, and center. They all try to freeze prices and rescue their companies. That will come, but cannot be done with the energy transition. And thirdly, of course, we see coal coming back and all these things. Also, Mike referred to nuclear back. That just indicates that this energy transition will be a much, much harder slog than people expected. And now I'm talking into your G1 poll or GI poll.
Yeah. I mean, this is the survey. I mean, I just thought we'd bring that up. Today's survey question, which is related, obviously, to the power fuel crises, not just crisis in Europe, but we're sort of seeing, amazingly, that I don't know. It seems to have caught, in a way, everyone by surprise. I don't know if you agree with that. I'll go to Mike on that. But there's the question for today: what will have a stronger impact on global economic recovery? Power fuel crises, i.e. what we've just talked about in China, plus what's happening in Europe, queues at gasoline stations, or central bank policy, i.e. can central bank policy, Mike, I'll go to you with that. Again, I think I put this earlier to Christoph, is it too late for central banks to get their act together? I mean, that's monetary policy. It will not have a big impact. Certainly, any interest rate action will do, though. Do you expect we'll see movement on interest rates anytime soon?
Well, I can just echo what Christoph said. I mean, in the end, governments have to grasp the reality, which is that you have a lot of discretionary consumer savings in the developed world. And you have, because I think savings outweigh redundancies and all the other pandemic impacts. And at the same time, you can't avoid the inflationary underpinnings of higher commodity prices, which oil is probably the least good example. I can't help but turn to the power crisis part of that question now that I hopefully won't influence too many people who've already answered. But I mean, it all starts with the dirtiest of commodities, coal, right? There's been a confluence of factors around the world. Coal has been underinvested in, and therefore there's no fresh capacity and there's no extra investment going into mines. At the same time, it's an aging infrastructure. So in countries that are rather dependent on their own coal, such as India and China, there have been production difficulties. You've had evacuation issues from rail in Russia to heavy rains in Indonesia, which is the biggest exporter in the world of coal. And then you've got less hydro in some of the major hydroelectric projects in Brazil and also in China. All this has basically made a great big sucking noise because that renewable source hydro and lack of coal means you've got to go for the next most fungible fuel, which is LNG. And the pace at which the world has put FSRUs in place to regasify means you have a very different picture to what you had a decade ago. LNG is a highly fungible commercial product, and it is now properly linked between Europe and international Asian prices, the JKM as we call it. And yes, winter forward months peaked at about $34.50 per MMBTU. And this is a proper market trading there many, many times over. Well, now it's somewhat off at 33 something, unlike the spike that we saw at the very beginning of this year, when that was really just a temporary short squeeze caused by extreme cold weather and a spike in power prices in Japan and Korea. So, I mean, this is underpinned because the coal market also is at unprecedented highs now. I mean, we're trading 200 and teens for the high quality stuff, FOB Newcastle, Australia. And it's Europe that's attracting some of the coal, which has to travel longer distance because the short-haul move Australia to China is still off the cards because the Chinese won't buy Australian coal. And the LNG market, therefore, is the focus of a huge amount of attention. And then it's rattled on through into European power markets, where a mix of capacity problems, demand, and I guess decarbonization and over-reliance on intermittent fuels, renewable fuels, wind and solar, has seen us with power prices in places like Spain and Italy last week that were above 210 euros per megawatt hour, which is astonishing.
That the world has been caught by surprise on so many fronts, both on how demand has recovered and on planning on the supply side. And just before we go to quickly look at the week ahead, I did want to touch base with both of you on Iran and the US, the two friends there. And on the supply side, there we go, just look at the result, power fuel crisis, 67%. That's probably no surprise, but central bank policy probably got more than I would have expected. Just to go on Iran, Mike, I mean, that seems to have kind of just, the talks, yes, there was some effort recently made to revamp them at the UN, but is the market at all considering Iranian oil production anymore, has just kind of discounted it for the next 6 months, let's say? And same question to US production. We're seeing rigs tick up a little bit, but again, have those two supply equations been put aside for the time being?
I think for this winter, there's none from either, because the rig count is simply not there for production to catch up in a way that would be necessary if you needed a huge amount of extra oil. And even if there were to be a very swift and surprising, to my mind, agreement between the various parties around Iran, it will still be several months before that will be forthcoming, because you have to work through how you get cash payments through the banking system, how you free up shipping companies, insurance, et cetera, et cetera. So I think for this particular winter, control over price is very much in the hands of OPEC Plus. And I've been saying this for quite a few weeks already. I think the consensus shifted. I said this in a couple of talks with Sean in recent weeks, that there will be no incremental Iranian oil over and above what is already going to markets where there's established flow, such as China, plus a bit of leakage of other products. Now, there's a possibility that may go up a little, but it was interesting that the Americans called on China to stop, or not just to resist the temptation to take more, but to stop. And now whether China really is going to heed that message is it drew some wry smiles out here. So that's it on Iran. And as far as the rig count in the Permian is concerned, yes, it's going up, but it's going up at a very slow pace, and it will not make a material dent in production in the coming weeks or months. Okay, Christoph, your views?
Yeah, Christoph, your views, and let's look at the week ahead as well. If you can add to that, do you see any change in the Permian in the week ahead, and what else are we looking out for in the next 7 days on the markets?
The week ahead will be very quiet. I went through the exercise of checking what announcements are there. Not much. These are the dangerous weeks. Holidays in China, quiet in the market, so some surprise will happen. But on Iran, I think it's a long-term obvious picture that Iran is a very, shall I say, stupid or binary policy. Whenever the US is firm and strong, all signals go towards negotiations. Whenever there's infighting in the US and nobody has time to look at Iran, then they suddenly retrench and dig themselves in. And this is what we're observing at the moment. There was a window which was blocked and after the Iranian elections, and now the US is busy with itself, and Iran happily is busy with whatever else they have with themselves, probably too. The Permian, again, we have discussed this before. The rig count is rising. The carrot of high prices is working. Still much more in private companies than in publicly traded companies. They will probably be too late. They have never really get their head around this manufacturing business, which is shale. They always have been miscalculated there. But it all points at the spring and the first quarter of 2022 when we see the effect of that. And Mike is right, it will not bail us out for the winter. And allow me one last word on the question on central banking, which Mike answered with the energy markets. We're forgetting one thing here, which is important. It's not central banks primarily anymore can change anything. It's the fiscal packages, which are in the pipeline somewhere. And I repeat pipeline because they're stuck. And the big debate in the US, which takes place now, and that's what I would look at next week, which actually is very important, is to what an extent they can manage to get at least the infrastructure project on the way. And that they can do only with the social expenditures. if that gets stuck, that will have an impact on energy markets. If that goes through, it also will have an impact on energy markets, both stronger and more immediate than whether the Fed talks a little bit more about tapering or not.
And certainly Biden has his own, as you said, he's distracted domestically at the moment. We had Afghanistan, and now we have his domestic sort of policy on all the bills that he's trying to get through.
Well,
Mike,
exactly those bills.
Yeah, last word, just on a market forecasting point of view. Volatility seems to be the name of the game for the months ahead. I think most analysts agreeing on that trend line may be up or down, but we're certainly in for a lot of volatility.
Yes, all I would add is I think we have now a mindset of potential scarcities, and therefore people will want to build inventories. I mean, Japan, Korea have had directives not to allow another power price squeeze as they suffered last winter. I think you saw my comments on China before. So at the very time that OPEC have it in their hands to take global inventories down to or below pre-pandemic levels, the world wants more inventory. So that's going to be a very interesting dynamic to see how it plays out.
Yeah, thank you. Yeah, and certainly they've achieved that target now. So they've achieved their 5-year average and beyond. So we'll see what happens. Thank you very much, Mike Muller and Christoph Ruhl, for joining us this morning. Thank you, everybody else as well. And have a great week ahead. And we look forward to seeing you tomorrow morning.